I'm going to do it like this. Hang on. Let's. There we go. Well, I look a little orange, but we're just gonna go with it, I guess. All right. So, hey everyone, welcome. My name is Kim Snider, and tonight I am going to make the case for Bitcoin in your retirement portfolio and why it's not as crazy as many of the conventional investment folks would have you believe. In fact, I believe that it is very, very sane. For those of you who don't know me, I'll give you my very quick backstory. In the mid 1990s, after having turned a very large windfall that I made in an IPO while still in my 20s over to a mainstream Wall Street brokerage firm who within 2 years lost everything that I hadn't managed to spend, I started reverse engineering the problem of financial freedom. And specifically, how do I get to the point that I can do what I want, when I want, without having to worry about how I would pay for it as quickly as possible? I had gone from set for life to deciding some days who would eat, me or my dog. I had been through the humiliation of having to ask my parents for money, selling my home that I could no longer afford for a massive loss, having my car repossessed, and having to give up my horses in the sport that I loved. And I was determined to never, ever be in that situation again. What I eventually ended up creating over a period of many years of trial and error and tweaking and refining came to be known as the Snider investment method. I won't go into all the details here, but I will say that that method was and continues to be very successful all these many years later. It was something that I originally created for myself, which over time some friends talked me into teaching to them, and then it just took on a life of its own. Over the years, I've literally taught thousands and thousands and thousands of people how to invest their money using the Snider method. We eventually became a registered investment advisor because people were asking us to manage their assets using the method. And at one point, we were at roughly $500 million under management and consulting, and we're on the Inc. list of fastest growing companies in America in both 2008 and 2009, which was quite a feat in the best of times, even more so given that that was the depths of the financial crisis and many banks and financial firms were going out of business. After successfully navigating our tribe through the financial crisis, I retired, sold the firm to some of my early employees, and moved here to Aiken, South Carolina to build my dream farm, play polo, and live happily ever after. And all was going perfectly according to plan until one day, a couple of years ago, knowing that I had been in the investment business, a very good friend of mine here mentioned to me that she had inherited $300,000 worth of cryptocurrency. And this was a big deal. She is in her early 60s. If I had to guess, probably earns about $100,000 a year. And she confided in me that they had been pretty far behind on their retirement savings. And so now, it's just her income and her savings. And she asked me if I had any opinion on what she should do. Now, at the time, I knew absolutely nothing about Bitcoin or cryptocurrency. My husband, Jim, is our family CFO. I was out of the business, had been for quite a long time. I hadn't even kept up or even thought about investing in years. And yet, do you know what my knee-jerk reaction was? The very first thing that popped into my head was, OMG, sell that. Are you kidding me? It has to be a scam. Now, I knew nothing about it. Nothing. Barely knew what Bitcoin even was. But my lizard brain says, alien, not my tribe, not mainstream, must be bad. That could be a saber-toothed tiger behind that rustling bush. Run! Now, fortunately, I didn't say that out loud. And I kind of forgot all about it, to be honest, until a few months later, she brought it up again. And now it was worth $600,000. And well, that kind of got my attention. And she told me, that she was having to learn about all the exchanges and that you buy and sell on, which was really confusing to her because she really hadn't ever been an investor other than her 401k. At one point, not really realizing the ramifications, she was literally like carrying this Bitcoin around with her in her purse. But what really got my attention was, like she had no strategy. Her husband had been an early adopter of Bitcoin, like way, way back. And so he was what is known as a hodler. HODL being a crypto acronym for hold on for dear life, if you're not familiar with that. Hodlers believe that you should never sell, ever. It's almost like an insult, like you're a non-believer, and they'll throw you out of the cult. So my friend was just hodling, which, as it turned out, was working out pretty well, because at one point she casually mentions to me that it's now worth $1.2 million. Like, you're not carrying that around in your purse, right? Of course, that was the top in January 2018. And she never took any money off the table. And to my knowledge, she still has it all. Well, about that time, like many people, throughout there, I started to get interested. So I started, to study it first, just to determine for myself if it was real or if it was a scam. As I said, that was my first inclination. And then realizing that, wow, it's definitely not a scam. This is kind of interesting. To understand the nuts and the bolts of what these different asset classes or assets were, and how you bought and sold them, and how do you value them, and and then how they might fit into an overall portfolio, like mine and Jim's or hers. And I created a fairly simple system for investing our money in crypto assets that I think makes way more sense than what other people are doing. Surprise, surprise. And and then one day, after hearing me ranting for probably the umpteenth billionth time about all the shysters and the scammers and or just terrible advice being given even by well-meaning people, she says to me, "You know what? I don't understand. This is what you do or did. This is what you say you love. Why, instead of complaining, why wouldn't you help people?" And I thought, well, you know what? That is a great question. So I bought the Sane Crypto domain the very next day, and now I am. And it's amazing how much can happen in a year of crypto. So let me tell you what we are going to cover tonight. What I am going to do is I am going to switch over here. Bear with me. I am going to go here like that. Okay, great. And then we'll go like that. So just so you're aware, tonight's program should last about an hour and a half, depending on how many questions I get. Could go a little shorter. And I am recording, barring any technical glitches, in case you have to leave early. So tonight, first of all, what we're going to talk about is, what is your most important job as a family CFO? Second, why I call Bitcoin the superfood of investing. And then finally, I'm going to show you the system that I use for investing in crypto assets. It's basically a step-by-step recipe that I use when we're investing our own assets. And then I will take just a few minutes at the end to tell you about my Sane Crypto Mastermind for those who want the diversification benefits and return potential of cryptocurrency, along with the guiding hand of a former investment advisor with a 20-plus year proven track record, which is namely me. So let's dive in. To understand why I think Bitcoin is not only a good investment, but an essential investment, you have to understand how I think about investing. My starting premise is that you have to invest. Everyone does. Even those with lots of money. Because if your money isn't growing by at least the rate of inflation each year, you are losing purchasing power. Now, I am not saying that you have to invest in Bitcoin, although you probably should. I am saying that you have to invest. I recently saw an article on the 10-year anniversary of the financial crisis. The headline was, "Post-Crisis, Wary Investors Miss Out on Huge Returns." And it said that only 10% of total respondents in this survey, 10 years later, invest more than they did 10 years ago, compared with 66% who said that they are now investing less. And that is crazy. I mean, I get it, but it makes me want to cry or shake people or both, because it is completely irrational, the opposite of sane. Your job as an investor is to take the money that you create from your intellectual capital and your physical capital, meaning your work, and transform it into enough financial capital to live 30 or 40 years in retirement without having to make decisions like, do I give my spouse the very best healthcare I can and risk running out of money myself? And that is not a hypothetical. By the way, this was the experience I had with my own grandparents. My grandmother, having suffered for many years with Alzheimer's, and having run through a multi-million-dollar estate by the time she died. Okay, so this is deadly serious stuff. Now, mathematically, to replace a $150,000 a year income and have a reasonable probability of living comfortably for just 30 years in retirement, which is not that much, will require a nest egg of at least $1.9 million, just as an example. And to do that is going to require, in addition to saving a meaningful portion of your earnings over time, a low double-digit return. Now, not all the time, okay? Some years the returns are negative, some years they are positive, but over time, over your lifetime, right? You need to average at least a low double-digit return. Now, unfortunately, the average 20-year return of the stock market has historically been around 8%, plus or minus. And the later you start, the less compounding you'll get. So the higher that average return will have to be to make up for it. So we're going to have to find some higher return somewhere. So you have to invest, and you need to be good at it, because this is not a game. The consequences are enormous. But in spite of what many people think or would have you believe, investing is really hard. And here's why. One, unless you have a crystal ball, which to my knowledge hasn't been invented yet, although I'm sure Silicon Valley is working on it, the future is a probability distribution rather than some fixed outcome that is knowable or predictable in advance. So you are playing a probability game. Second, you are playing that game with a lizard brain, a prehistoric lizard brain, which happens to be hardwired over millions of years of evolution to be very bad at probability games. And third, investing is a zero-sum game, which means if you make $500, someone else has to lose $500. And you are playing that game against some of the brightest minds in the world, literally with unlimited resources, unlimited money, unlimited computing power for the ultimate prize, which is money. And then finally, as if that wasn't hard enough, the playing field is designed to disorient, distract, and deceive you. The financial press and nowadays social media is filled with propaganda, misinformation that acts like the bells, lights, buzzers on the casino floor. It's all a great system designed to part you from your money. But lest you think it is an impossible game, it is not. You see, investing is hard, not because it's rocket science or only an expert can do it, but because we are humans. In fact, Morgan Housel, in a really great article that I recommend to everyone called The Psychology of Money, gave a perfect example. And if you'll excuse me for doing so, I'm just going to read a little part of it for you here. He says, Grace Groner was orphaned at age 12. She never married, she never had kids, she never drove a car. She lived most of her life alone in a one-bedroom house and worked her whole career as a secretary. She was, by all accounts, a lovely lady, but she lived a humble and quiet life. That made the $7 million she left to charity after her death in 2010 at age 100 all the more confusing. People who knew her asked, where in the world did Grace get all that money? But there was no secret, there was no inheritance. Grace took humble savings from a meager salary and enjoyed 80 years of hands-off compounding in the stock market. That was it. Weeks after Grace died, an unrelated investing story hit the news. Richard Foscone, former vice chairman of Merrill Lynch's Latin America division, declared personal bankruptcy, fighting off foreclosure on 2 homes, one of which was nearly 20,000 square feet and had a $66,000 a month mortgage. Foscone was the opposite of Grace Groner. Educated at Harvard and University of Chicago, he became so successful in the investment industry that he retired in his 40s to, quote, pursue personal and charitable interests. But heavy borrowing and liquid investments did him in. The same year that Grace Groner left a veritable fortune to charity, Richard stood before a bankruptcy judge and declared, I've been devastated by the financial crisis. The only source of liquidity is whatever my wife is able to sell in terms of personal furnishings. The purpose of these stories is not to say that you should be like Grace and avoid being like Richard. It's to point out that there is no other field where these stories are even possible. In what other field does someone with no education, no relevant experience, no resources, and no connections vastly outperform someone with the best education, the most relevant experiences, the best resources, and the best connections? There will never be a story of a Grace Groner performing heart surgery better than a Harvard-trained cardiologist or building a faster chip than Apple's engineers. Unthinkable. But these stories happen in investing, and that's because investing is not the study of finance, it's the study of how people behave with money. So, how does Bitcoin and cryptocurrency fit in? Remember I said that we need to find some higher return somewhere? Well, that's one way. But the other less obvious benefit of investing in Bitcoin is that it reduces your risk in 2 meaningful ways, which is totally antithetical to what most people believe about Bitcoin. But you know what? Actually, I'm getting way ahead of myself because based on your survey answers that you all gave me when you signed up for the training, we have a lot of people in the room at differing levels of knowledge about what Bitcoin even is. So let's do this. Let's start at the beginning so that we're all on the same page. And then I'll come back to these 3 points about risk and return. Okay? All right. The best way to understand cryptocurrencies from an investment perspective is internet is to blockchain as email is to Bitcoin. Meaning, internet was this obscure technology that no one really understood or knew what to do with in the mid-90s, beyond a few nerdy computer scientists, until AOL started mailing out millions of CDs by snail mail. And suddenly, email became the killer app that opened the floodgates to widespread mainstream adoption of the internet. Y'all remember this?
You've got mail.
It's like so quaint now, right? But I mean, it was like a cultural phenomenon, not that long ago. Well, today, blockchain is the new, obscure, potentially disruptive technology, and Bitcoin is the compelling first use case that is starting to drive widespread mainstream adoption today. Now, whether Bitcoin eventually becomes as ubiquitous as email remains to be seen. But it is important to understand that this is really early days for blockchain and Bitcoin, okay? So think, early to mid 1990s for the internet. And the question is, if someone had created an investment in 1993 that you could buy and sell on an exchange similar to a stock that allowed you to bet directly on the future success as measured by widespread adoption and use of email specifically and the internet more generally, knowing what you know today, would you take that bet? Well, with the benefit of 2020 hindsight, of course you would. That would be amazing, right? Now, of course, we don't have the benefit of 2020 hindsight on Bitcoin and blockchain yet, but there is an investment called Bitcoin that you buy and sell on an exchange, just like a stock, that allows you to bet on the future success as measured by widespread adoption and use of digital currency specifically and blockchain more generally. And the question is, knowing what we know now, should you take that bet? That is the question that we're trying to answer tonight. So let's dig a little bit deeper into blockchain and Bitcoin. What is blockchain? Well, blockchain is the technology underlying all cryptocurrencies. Blockchain is software, just like the internet is software. And just as the internet protocols like HTTP and FTP and TCP/IP gave us the ability to transfer data, i.e., files and music and videos and images, right, around the globe in the blink of an eye, peer-to-peer, meaning person-to-person, without relying on a trusted intermediary like FedEx or the post office. Blockchain gives us the ability to transfer value anywhere around the globe in the blink of an eye, peer-to-peer, without relying on a trusted intermediary such as a bank or a government. So it's the internet of money, basically. Now, where does Bitcoin fit in? Well, just as email is software that use the internet to send data person to person, Bitcoin is software that uses the blockchain to send payments person to person. But this is where people get confused. Because of some of the early choices of terminology by the inventors, before they really even knew what Bitcoin would become, terms like digital cash and cryptocurrency, which turned out really to be unfortunate misnomers, people assume that the use case for Bitcoin is buying pizza and Starbucks, and it is not. Other cryptocurrencies may eventually solve for that, but those won't be good investments any more than the US dollar is a good investment. The things that the payment rails, you want to be stable, right? An investment, you want to have price movement. That's what an investment is, okay? So the way to think of Bitcoin from an investment perspective, which is all I care about, is as a store of value. In other words, as a better gold than gold. Meaning that an ideal store of value will be durable, portable, fungible, verifiable, divisible, scarce, have an established history, and be censorship resistant. So this chart summarizes these characteristics for Bitcoin, gold, and fiat currencies. And in case you're not familiar with the term fiat, Robert Kiyosaki says gold is God's money, fiat is government money, and cryptocurrency is the people's money. So fiat is things like the US dollar, the British pound, things like that, government issued money. Now, unfortunately, I don't have time to spend on all of these, but let me just touch on a couple very quickly, right? For example, in order to be a better gold than gold, something has to be very easy to transport and store. Well, Bitcoin's the most portable store of value ever used by man. Private cryptographic keys, which you can think of as basically like a password on steroids, potentially representing literally hundreds of millions of dollars, literally can be stored on a tiny USB drive. This isn't one, but they would basically be like this size. You could have like millions of dollars on something like this. In fact, my friend did. I told you she was carrying something like this before she figured it out in her purse. So you can literally you can walk across an international border with millions of dollars in your pocket or in your head, if you can remember that passphrase. And equally large sums of money can be transmitted between people on opposite ends of the earth almost instantly, like without any intermediary like a bank or a central government, which is why Robert calls it the people's money. It also has to be divisible, meaning easy to subdivide. Now, one of the common objections that I hear about investing in Bitcoin is that the price is too high. Over the last year or so, Bitcoin's price has been from a few $1,000s to $20,000 US and everywhere in between. And it is not uncommon for someone to see that sort of price and think that Bitcoin is totally out of their price range, sort of like people used to do back in the day with Berkshire Hathaway or something. But very few people, especially those that are used to investing in stocks, realize that Bitcoins can be divided down to 100 millionth of a Bitcoin, which is like 8 decimal places. So I can buy literally $10 worth of Bitcoin if I want. And I can send or transfer in those tiny increments as well. I can buy or send, a couple dollars. I can buy or send millions of dollars. And nobody can tell me I can't do it, okay? So that's what we mean by divisible. Now, the one attribute that most clearly distinguishes Bitcoin from fiat currencies and gold is its predetermined scarcity. By design, at most, 21 million Bitcoins can ever be created, ever. It's all there ever will be. And this is going to be key, as you'll see later on in this presentation. Censorship resistant means how difficult is it for, a corporation or a government to prevent the owner from keeping and using it. And censorship resistance might not be a big deal for those of us here in the United States, but it is a very big deal if you live in parts of South America, Africa, the Middle East, or China, say. When Bitcoins are transmitted on the Bitcoin network, there's no human intervention deciding whether that transaction should be allowed or not. It's a distributed peer-to-peer network. And so by its very nature, it is designed to be censorship resistant. So this is the most compelling use case for Bitcoin as a store of value, not as digital cash, but digital gold. And this is also the bet that it will succeed in supplanting gold in whole or in part as the preferred store of value going forward. Someone said to me the other day, you'd have to be crazy to buy Bitcoin. And I get it. I do. Because coming from a traditional investment paradigm without understanding the play, that's what I initially thought too. But we're not talking about investing in a stock here. This asset can't be valued using like standard discounted cash flow analysis or demand for higher, production of higher order goods like a commodity, okay? And its price movements and its price potential are on a totally different scale than stocks. Bitcoin's, in fact, fall into an entirely different category of goods known as monetary goods. And you can see that, at the moment, relative to other markets, cryptocurrency is just this little teeny tiny guppy at a total market value of, roughly, we'll just call it 200 billion US, okay? The world's 50 richest people have a total net worth combined of approximately 1.9 trillion with a T. So there you go. And the market cap of the global stock markets is about 73 trillion. But let's take a look at gold, okay? Because that's what we're talking about here. And imagine a couple of scenarios, keeping in mind that there is ever only going to be 21 million Bitcoin in the whole world, ever. And imagine best case that, Bitcoin is successful and literally becomes the dominant payment system in use throughout the world, okay? Replaces fiat currency completely. Could happen. I mean, look at Amazon. They're going to be their own country soon. Current estimates of total worldwide household wealth range from like 100 trillion to 300 trillion, 20 million Bitcoin. That gives each coin a value of, $10 million a piece. Or if it only competes with gold as a non-sovereign store of value, mapping the market capitalization of the existing above ground gold supply, which is about 8 trillion, to a maximum Bitcoin supply of 21 million coins. Now that gives us a value of approximately $380,000 per Bitcoin. Or if you ratchet it down to just store value used only by retail and institutional investors, okay? Assuming, Bitcoin's still really early in its adoption curve, we're seeing more and more institutional investors, that gets us to a price level of like 100,000 to 200,000 per Bitcoin. Actually, totally feasible. Now, I know that sounds crazy. That is why every time I say things like that, I laugh, right? Out loud. But here's the thing. It as crazy as it sounds, it is possible. It's not certain, by any means, right? But it is well within the realm of possibility, which is really crazy when you think about it. I mean, but again, okay, let's think about it, but let's think about it in a little bit different way. Imagine if someone had allowed you to buy stock in the internet back in 1993, and instead of this chart that we're looking at being financial, we were looking at email in 93 as compared to the market for FedEx, UPS, DHL, snail mail, faxes, and phone calls over landlines. Okay? Like, what might the value of that investment be now, 25 years later? Well, the value is based on the network traffic and adoption of the internet. It's incalculable, literally. I mean, and it would have seemed equally crazy at the time. So let's just say, I may sneeze here in just a second. Let's just say that you accept my investment premise of a better gold than gold. In fact, you think that this is really exciting. Do you just, back up the truck and buy as much Bitcoin as you can? Absolutely not. Okay. So let's take a look at how I think Bitcoin fits into the big picture. So in my world, I take a waterfall approach to portfolio design, meaning that I think of each asset class as having a job. And that part isn't necessarily that unusual. But what most financial advisors will do is they will just take 100% of your investable assets and they'll divvy that money up against or amongst all those different jobs, amongst all the different asset classes all at once. And I don't do it that way. One of my very favorite books, and one that I highly recommend if you have not read it, is called The One Thing by Gary Keller, co-founder of Keller Williams Realty. And The One Thing offers a clarifying question, which I find useful on an almost daily basis. And that is, the question is, what is the one thing that if I did it right now would make everything else easier or unnecessary? So, what is the one thing that my portfolio must do? The one job that it must accomplish that would make everything else easier and unnecessary, and I allocate all the money to that job until I get that job accomplished. And then, and only then, do I begin allocating investable assets to the next asset class to fulfill the next job, okay? So in my case, its highest purpose, the one thing that my portfolio must do for me, if I could only pick one, is to provide financial freedom. And again, as I said at the very beginning, I define financial freedom as the ability to do what I want when I want without worrying about how I'm going to pay for it. And the assets that I'm going to invest in order to accomplish that are what are called cash flow assets. Then, once I've accumulated enough cash flow assets, then and only then do I move on to the next job. And the next thing in my world is protecting against hyperinflation. And the asset class that we typically invest in order to protect against inflation, specifically hyperinflation, is commodities, things like meats, metals, grains, energies, etc. And that is because in an inflationary environment, commodities, hard assets, they go up in price. That's the definition of inflation, okay? Then, once I have enough of my portfolio to where I feel like I have that covered, then and only then do I then begin to invest in non-correlated assets in order to address market risk, which is the thing that everybody else does first. Non-correlated means that mathematically, they don't go up and down together. They tend to go up and down over time, separate from one another. There's no causal relationship, okay? So hopefully, if you have enough of them in any given year, some are up and some are down. All right. So one example of a non-correlated asset would be real estate, for example. And so this is the idea of modern portfolio theory and a diversified portfolio and why we own different things. But for me, that's job number 3. And I typically don't start investing in non-correlated assets until I've got the first 2 taken care of. And that's why I call it the waterfall approach. So if that's my world, where do crypto assets fit in? And it's funny because crypto kind of upended my worldview. So I'll tell you how it fits. Crypto assets aren't cash flow assets. So it's really no benefit in that regard. But interestingly, we have quite a lot of, I'm going to call it anecdotal evidence for now, just because the time period that we have to look at, is like only 10 years. But we have seen in countries like Argentina, Zimbabwe, Turkey, Greece, Venezuela, etc., that the price of Bitcoin does go up in periods of hyperinflation, as we would expect, it being a digital commodity. And so it does help us or serve as a hedge against inflation and financial crisis. Okay? And it is also a non-correlated asset. Again, correlation is a mathematical equation, and it is measured on a scale of 1 to -1, with 1 being highly correlated, meaning the assets, again, go up and down together, 0 being uncorrelated, and -1 being negatively correlated, meaning that they'll tend to move opposite to one another. Well, the 3-year correlation of the S&P 500 to the NASDAQ, for example, is 0.95, almost 1. Meaning, as you would expect, they are very, very, very correlated. The 3-year correlation of Bitcoin to the S&P 500, NASDAQ, gold, and Brent crude is -0.01, -0.02, 0.05, and 0.01 respectively, meaning it is uncorrelated with all of them and therefore provides mathematical diversification to the portfolio. Seth Klarman says the 3 best ways to reduce risk are diversification, hedging, and buying with a margin of safety. Now, we'll get to the margin of safety in a minute, but for now, Bitcoin checks both the diversification and the hedging boxes for us. A second benefit, is diversification of your money, which is different than the portfolio diversification, that benefit that we just discussed. So if I had drawn this correctly, really, the waterfall should look like this. Meaning, before you even begin investing, the first priority is to create an emergency fund of at least 6 months of expenses, and preferably 12 months. I'm not an alarmist by any stretch of the imagination, but as I said in today's email, if you happen to see that, I do and always have had hope for the best and plan for the worst as a core financial philosophy, a touchstone for me. And in keeping with that, I believe that you should also have some money outside of the banking system where it's accessible in the event that if the shit were to ever really hit the fan, it just is a matter of prudence, and so it only makes sense to me that money should be diversified as well by holding some of it in native currency, which for me is dollars, some of it in cryptocurrency, which for me means Bitcoin, and some in gold, in order to provide that, liquidity and safety. So a second benefit is diversification of your money. And the third risk pickup, which is the one that you hear me talk about the most, is the outsized return potential. Quoting Charlie Munger, he says, risk to us, if you don't know who Charlie Munger is, he's Warren Buffett's partner in Berkshire Hathaway. So when he says us, he means he and Warren, he and his BFF Warren. He says risk to us is 1, the risk of permanent loss of capital, or 2, the risk of inadequate return. Howard Marks, who I just had featured on my podcast this week, says the same thing, but in a different way. He calls, instead of the risk of inadequate return, he calls it, the opportunity cost, the lost, the cost of a lost opportunity. Same idea, okay? Well, the historical rates of return of Bitcoin have been these amaze me every time I look at it. 1,395% in 2011, 200% in 2012, 5,525% in 2013, then minus 59% in 2014, 36% in 2015, 124% in 2016, 1,307% in 2017, and in 2018 year to date, we're down something like 70%. Now, is that volatile? Yes, totally. Okay, because there's nothing that gives you this sort of return. Works out if you go back to the beginning, 10 years ago. In 2010, it started at 5 cents. That's something I think I worked it out today. It was like a 13,000% return over 8 years. Okay, there's nothing like that that's going to go up in a straight line. Okay, obviously, right? So yes, totally volatile. But note that Charlie Munger said permanent losses of capital, not temporary losses of capital. Okay, and this is the hardest thing for the lizard brain to grasp. And inadequate returns are a massive risk, as we talked about at the beginning, far bigger than the risk of losing the money, so long as you don't let your lizard brain get greedy and invest too much. Okay? So in my world, it's not part of the waterfall. It's something that we do right away. We peel off 2% of our investable assets off of whatever we're doing, wherever we are. And let me rephrase that. It could be less, but no more than 2%. And we put that into crypto assets. And the reason that we're buying it now is it is this potentially once in a lifetime opportunity with a massively compelling upside downside skew that diversifies and hedges our portfolio as well as our money. So we don't wait. It doesn't go into the waterfall. Assuming that it is suitable, it is something that we peel off right now and do. Now, that is all with the understanding that it could happen that the moment you buy it, it heads straight south and never ever recovers. Okay? While most of what you hear or read about crypto assets, I'll just tell you, is complete worthless garbage. On both sides, bull or bear. There are a few sane voices in the space, okay, serious thinkers and academics. And to be clear, they do not agree on the future of cryptocurrency. Some make a super cogent argument for Bitcoin at $1 million, which I made for you. Others will argue, vociferously that Bitcoin's going to go to zero, right? Or, we'll call it 1. Nobody knows. Only time will tell who is right. But in the meantime, okay, understand that somewhere between 1 million and 1, there are lots of other scenarios, including, and this is important, taking a really long time to play out, okay? Remember that we're 25 years into the internet right now, okay? With lots of ups and downs. So understand that this is a long-term play, which is why a very small amount of risk capital that you can afford to write off is key. So now we know how it fits into our retirement portfolio strategically. We can start to look at it tactically, okay? So let's start with some scenarios and who it's suitable investment for and who it isn't. So let's start with Jack, okay? Jack's retired. He has a $500,000 portfolio, and that portfolio is producing exactly enough income for Jack to live on with absolutely no room for error. If he were to lose any of that portfolio or any of that income, right, that would be super meaningful. In that case, crypto assets are not a suitable investment for Jack because he doesn't have any risk capital to invest. Okay, my definition of risk capital is that losing some or all of it would have a meaningful impact of your standard on your either current or future standard of living, or not just losing it, but like in Jack's case, he couldn't even afford. Let's just say he had to sit on it, like he invested it, and it took 3 or 5 years for it to for those profit numbers to be realized. Well, he can't live without the income that portfolio is producing over that 3 to 5 years that it's dead money, right? So it's not suitable for him. The key is that you cannot invest money you can't afford to lose, no matter how compelling the upside is, okay? On the other hand, let's take a look at Jill. Jill is 62 years old, lives in the suburbs of Des Moines, Iowa. She's divorced, has 2 adult children, and a grandson, Zach, who she adores spending time with. She's still working as a school administrator. She hasn't started taking Social Security yet. She has also a $500,000 portfolio, spread over her 403B, her IRA, taxable accounts, and she owns stocks, bonds, REITs, and commodities, all in low-cost index funds. And she would love to retire in 5 to 7 years, say, but she's not sure she's going to be able to, because while she is on track, she'd have to cut back a little bit to live off of her retirement income. And she's also a little bit concerned about the cost of health care if she gives up her benefits from her job. So let's take a look at the math for Jill. So again, okay, the way that I think of an investment portfolio is in terms of the sustainable cash flow that it can generate. Since for me, that is job number one for for a portfolio, right? So just to use a simple rule of thumb that most people are familiar with, even though I'm not super crazy about it, but anyway, it makes it simple. Given a 4% withdrawal rate in retirement, the cash flow potential of Jill's portfolio right now is $20,000 per year. Okay, that's $500,000 times 4%. And this is in addition to Social Security, which she plans to start taking at 70. The assumption, based on my rule from earlier, is that Jill would only invest up to 2% of her investable assets, which in this case, 500,000 times 2%, that would be $10,000 maximum investment. Okay, so let's just consider worst case. Jill invests $10,000 in crypto assets, and she loses it all, 100% loss. The income potential of her portfolio has fallen from $20,000 a year to $19,600. Not ideal, but also not catastrophic. Okay? But on the flip side, let's not look at her Bitcoin going to $1 million or 500,000 or even 100,000. Okay? Although again, there are valuation models under which that is not completely and totally far-fetched. Let's just take the returns of 2017, which were just over 1,300%. Okay, so they happened last year. No guarantee that they'll happen this year or ever again, but just to try to show a reasonable upside scenario here, okay? Last year, her $10,000 would have turned into $124,478. That is what we mean by a ridiculously favorable upside downside skew. If you are completely wrong, you lose the entire $10,000, your retirement income potential drops by $400. But if you are right and you just get last year's returns, your portfolio income is now $25,000. That is a 25% raise for life, for the rest of your life. That is massive. And oh, by the way, break even is the opportunity cost of the investment that you moved it out of. So chances are anything above a 6 to 8% return over time is going to be a win. Because return notwithstanding, you also got the benefit of the diversification and the hedge in case the crap hit the fan. Here, as I said to Larry the other day, look, it's a little bit of a moonshot, but with the potential to push you into orbit if it works and not hurt anything too badly if it doesn't. But that assumes it is a suitable investment and you don't screw it up by getting greedy and ruining it by investing too much. That is key. I think each of you should have copies of the Sane Crypto Retirement Calculator in the emails that I sent to you prior to this training. If you don't, you can get it by going to the website, my website, sanecrypto.com, and clicking the link at the top that says free tools. Do this math for yourself to see what both the upside and the downside would look like for you. If losing 2% of your portfolio would meaningfully affect your future security and standard of living, do not do it. It is not for you. But if it wouldn't, to pass up the potential upside with the benefits of diversification is insane. And one last thing, by the way, if you'd like to discuss the retirement calculator and your results on that, then feel free to schedule a call with me for free at sanecrypto.com/schedule. Okay? Does that make sense? Okay. All right. If it does, then with your permission, let me check the time here. Oh, good. We're right on schedule. Okay. I'd like to take a quick minute to tell you about my Sane Crypto Mastermind. If you happen to hear my interview on my podcast a couple weeks ago with Dr. Meyer Statman, who's one of the fathers of behavioral economics, he said, good advisors are more managers of investors than investments. And I couldn't agree more, which is why the goal of the mastermind is to, one, give you the confidence to make an investment in crypto assets, if appropriate, knowing that you don't have to figure all this out on your own through trial and error, which is the investment piece. In fact, one of our members was kind enough to leave us a review on Facebook recently. I noticed that it spoke to exactly that, which must mean I'm getting something right. He said, the knowledge was invaluable, well worth the money. I could have never researched all this myself and felt confident about what I was doing. Plus, the lessons in cybersecurity were invaluable. Thanks for all of your help. And two, more importantly, the goal is to help you make more money and keep more money than doing it on your own, which is the investor piece. And we achieve both of those by having a system. This is mine. I know it's a lot on one page, okay? To some of you, everything that is in the system will be very familiar because it is everything that I have ever said or ever taught about investing, just applied to this new asset class called cryptocurrency. And the point of the system is to tell your lizard brain, that prehistoric lizard brain, okay, what to do in every possible scenario so you don't screw it up. No guessing, no room for improvising or interpretation, okay? As we always do with all of my investment systems, we put your lizard brain in a nice, cozy box and we don't let it out no matter how loud it screams at us. And that is because, again, back to the psychology of money, investing is easy except for the fact that we're humans and we have this lizard brain that wants to do the opposite of what we should be doing in every possible scenario. Okay? So what I have done in the mastermind is I have created a detailed video library that covers the what, when, where, how, and why of every single step in the system. Nothing left to the imagination. It is a step-by-step, hold your hand, push this button, fill in this field recipe. And you get instant access to that video library the moment that you join. You also get unlimited updates to the system, to the videos, to everything. One of the questions I get quite often is, does it change much? And oh my goodness gracious, compared to the stock market world, it is incredible how much things change. You blink and some things change. So, again, as with all of my systems, the good news here is that this is the way that I am investing my own money. And so I have a vested interest in keeping it up to date. And as things become available, things change, we learn things, then you have the benefit of that. Basically, unlimited means, until I stop doing this, basically, you pay one time for the system and then you get unlimited updates, okay? You'll also get unlimited phone and email support from, at the moment, it's from me. If you have a question about anything, then you just holler at me and we'll work it out together. There's an archive of support questions, which what this means is, in the beginning, I thought that we would do like a Facebook group or something, but my audience, they were like, no, forget it. And then I realized, that doesn't work anyway, because really, if you're in the middle of this and you can't figure out, how to do something, you want an answer. You don't want to wait, to post it in a Facebook group and, me to answer 3 days later. So, you pick up the phone and you call me or you send me an email and, during business hours and I'll get back to you. But I also, what I do with those questions that I get is, one, I add them to the notes underneath the relevant video, but for clarification. But I also created like a reverse time-stamped archive. And that way, as you're going through something and you say, you know what, I know that I saw the answer to this, but I can't remember which video it was on. You don't have to do that, although it's all searchable, but you can just go to that archive and go, oh yeah, here's that answer, okay? There's weekly member emails as needed. I don't just send them gratuitously, but if there's something I need to tell you or something that has changed or some point I want to make, then you get an email. That is our primary way of communicating. You also get my cell number. And the reason for that is, at the moment, as I said, I'm just one person. And so during regular business hours, I'm usually, email or the business phone will suffice. But if you really gotten into a jam and you have an urgent issue and you need my help right then that is the reason for having my cell phone number, okay? Clearly, as I mentioned, this is not for everybody. Some people will know that it's not for them just based on the suitability. Other people, it may or may not be just, based on like your your temperament and how you react to these things going up and down, whatever. It doesn't, it doesn't, or you might not like learning by video or something. So whatever. I don't want you to be concerned that, oh, I'm going to spend this money and it's going to be a waste, which is why I offer a 6-month no hoops, no hassle guarantee. If it doesn't, whatever, for whatever reason, you just let me know and we'll refund you 100% of your tuition. Someone who had actually been in cryptocurrency for a while left me this note on Facebook. He said, "Hey, Kim, I've been watching your videos, listening to your podcasts. I think they're wonderful. I enjoy them all, and I truly appreciate both your philosophy and opinions and the practical and helpful nature of the masterclass," I think he meant mastermind, instructional videos. I had no idea how much I had no idea about. And it feels so good to have you walk through the steps and show how it all works. So I appreciate that. To join the mastermind, you can find more details at sanecrypto.com/mastermind. It is a newish program, just so you know. Well, I say it's newish. Now, I really kind of got serious about it in about February-ish. So what is that? 6-8 months, something like that. We've got about 60 people in the program right now. Because I still think of it as beta, really. So because of that, I am offering $100 off the initial rack rate, which is $997 at the moment. $100 off that if you use the promo code by Thursday at midnight in exchange for being an early adopter. And the reason I say that is because things still are changing so fast that I am focused still mainly on content, not bells and whistles like some fancy membership site. A video might not exactly match a spreadsheet. Ledger Wallet just came out with Ledger Live, and so I had to redo 8 or 10 videos, which is no small undertaking, right? So an understanding of things like that basically is the reason that this price is still as low as it is. And the discount encourages you to move fast, which is for your own good, because over time what I have been doing is ratcheting down the discount, as you can see, and also ratcheting up the price. So the discount code at the moment is SANE. This week is SANE 100. It's actually all one word. I've got it 2 there. SANE 100. And if you do sign up, please remember to hit the apply button when you put the coupon code in. If you don't, you won't get the discount, which for some reason happens at least seems like once a week. All right. So that is all I have got about the mastermind. So let's go to Q&A. What time we got? Okay, we're doing good. Okay, hang on here. Okay, Tom says, hey, Tom. Tom says, being a long-time investor in your other investment strategy, I am very comfortable with the inherent risk-reward component of that strategy. My question is, how does the risk-reward component of this compare to that? Okay, and so just so everyone else knows what Tom is talking about, so he is referring to, as I said at the very beginning, the Snider investment method, which is the thing, which is in the waterfall, where it says cash flow assets. That's the Snider method. The Snider method is the cash flow, is designed to produce that cash flow. And so he's asking me to compare the two. Well, okay, so the principles are the same. Okay, as I said just a minute ago, everything that I have ever said about investing, first principles don't change. Okay, so we're just taking the most basic rules of investing and we're applying them to a new asset class called cryptocurrency. And when I say first principles, they will be things that you are very, very familiar with. things like, planning for the worst and hoping for the best, making sure that you're okay no matter what. Pigs get fat, hogs get slaughtered, controlling, managing the emotional aspects of it, all of those things, right? Those are all still there. Now, the risks and objectives of this investment are completely and totally different. That is all about cash flow and, X% above the, risk-free rate of return. This is about, this does, has a totally different job, right? It actually serves multiple jobs, as I just outlined. And we hope, although there's certainly, where the Snider method was more about trying to create consistency over long periods of time, this is going to be very inconsistent, and we hope that it's going to be a huge number, but there's no guarantee of that, which is why we're investing so little. So, this has, I would say, some people would say that the risk of loss is higher. I actually really don't think of it that way. I think the volatility is the biggest risk, and it's not a risk in the traditional sense. As the biggest problem with volatility is it causes people to sell at the wrong time. It causes people to sell at bottoms and buy tops, but that's the whole point of the system. The same as the Snider method is to keep you from doing that, right? So, so I would say, it's definitely higher up on the risk scale. It is different objective, clearly. It's a much smaller portion of your portfolio, but the principles will be, the higher order principles will be the same and familiar. Hopefully that answered your question sufficiently. If you have any specific questions, then let me know. But position sizing is really, really, really important. Okay. Okay. Trish says, why would I want to buy cryptocurrency when all they have done is go down? Shouldn't I wait until they go back up again? Trish, this is exactly why you need the mastermind, which is to put that lizard brain in a box. Okay. So this is really, this is the classic issue, isn't it? If we have a, here in South Carolina, we have a sales tax holiday before the kids go back to school, or imagine like school supplies are on sale, right? Or Black Friday. In normal circumstances, when things are on sale, you rush out to buy them. The curve, as Howard Marks, said the other day on my show, is like, in microeconomics, says that as price goes down, people will buy more. But in investing is the one place where we have it totally backward, right? What happens is the opposite. What we want to do is, as the price goes down, we want to sell it. And when the price goes up, we want to buy it, which is the exact opposite of what we should be doing. What we should be doing is buying when everyone else is selling when everyone else is buying. The fact is, all markets go down. There is no such thing. Well, there's the risk-free rate of return. If you're okay with 2%, then there's no risk of it going down, right? But the more return you get, the more variability there is by definition in that return. And the key thing here is, if you look at billionaire investors, like, you know what? Actually, let me just show you something. I'm going to go back here. Bear with me. I didn't look at this chart. I want to just make another point here real quick. This wasn't my point in showing you this chart, but I've got it. So I'm going to use it here. Trish, see, so these green bars here are the return of the S&P 500, which is the U.S. stock market, going back 2002 to 2016. Okay, these red bars are the return of the average stock investor. Okay, and the difference between the green bars and the red bars, the difference between the investment and the investor, is caused by this very thing that you're asking about. It is caused by our inability to, our tendency to do the exact opposite, which is to sell when things are going down and buy when things are going up. right? That is what causes this disparity between the investment return and the investor return. And you can see it is massive. As a rule, retail investors underperform their investments by massive, and it's true whether it's bonds, it doesn't matter. The point is that, which is why you have to have a system. But the point is, when you look at any of the investors who have made their fortunes in the markets, Warren Buffett, the Big Short guys, Sir John Templeton, etc., what you find time and time again is that the only thing that really sets them apart from everybody else is that they have this ability to buy when everyone else is selling and sell when everyone else is buying, which is the hardest thing to do, really. But it's the key to everything. You can't make money doing it the other way around. So the answer, that's a long way of saying, where was I? That's a long way of saying, no, we shouldn't be waiting until it goes back up. I can't figure out how to get rid of there. There we go. It's on sale. It's on sales for 70% off, right? So it's definitely a better time to buy now than later. All right. All right, I'm gonna get it. I'm like parched. Sorry. I'm gonna get a drink and then I'm gonna get the rest of these questions. Okay. All right. Hopefully I'm not mispronouncing your name, Sidra. Hopefully that's right. I appreciate the examples you're using for current portfolios. How does your program apply to someone who's in their 30s and building a portfolio? And then a follow-up question, how would one decide how much to allocate? I led a 10-week Rich Woman book study group 10 years ago, and we used your interview with Kim Kiyosaki as one of the topics of the meeting. That is awesome. No kidding. Okay, so the fact that you're in your 30s is really neither here nor there. I mean, yes, I tend to speak more to baby boomers because that is who my cash flow investment was much more appealing to. Although, again, I created it for myself when I was in my 30s. So it's just people in their 30s don't typically think like that. Now, so that said, it doesn't apply to you any differently than someone who's in their 60s. What you would do is you would, so a portfolio typically is going to be rebalanced, periodically over time as pieces of it grow and shrink. So if you were to take 2%, so when I say 2% of your investable assets, I mean 2% of, that's taking like your 401ks, your IRAs, your whatever, your taxable accounts, your real estate, if you've got real estate investments, things like that. Add that number together and then take 2% of that, and that's the amount that you're going to put into crypto assets. Up to that amount, as I said, could be less. Now, it doesn't mean that you're gonna. I had someone the other day who started to say, well, he had X amount is Roth and X amount is in a taxable, and he was trying to put 2% from each in there, which you could do, but that's not the point. The point is just to say 2% of your investable assets across all of your portfolio. And if over time, as I would hope, if you're in your 30s, your that portfolio is growing, right? Then great. You could add to it if you wanted to, or if Bitcoin is going crazy, then as part of our system, we would be taking some of that money off of the table to be reinvested in other things, right? So that's what that would be kind of happening just naturally, like I said, this is just investing. We're just adding one additional asset class that just happens to have this potential to go, really big. So nothing would be different, basically. Did that answer your question? I hope. Okay, Craig, can you invest Bitcoin in a Roth IRA? Yes, the answer is yes. So I'll qualify that. And you can find information about this in detail on my blog. There's 2 or 3 different blog posts that talk about this in great detail. However, so there's 2 ways to do this. One is easy but not ideal, and the other is hard but better. So the easy but not ideal way is to invest. The only way you can invest through a traditional brokerage firm, like if you're Roth at Fidelity or Schwab or whomever, directly within that Roth at Schwab or whomever, is through something called the Grayscale Bitcoin Investment Trust, which is kind of sort of similar to an ETF, but it's not really. The biggest, it has a ticker symbol of GBTC. The biggest problem with it is that it trades on average at about a 40% premium to Bitcoin, meaning that basically if you were buying Bitcoin directly, you would be able to buy twice as much almost on any given day. It also, because that premium expands and contracts, some days like Bitcoin can go up, but GBTC can go down, so it doesn't track the net asset value directly. There are fees. There are a number of problems with GBTC, but for some people, particularly if the investment amount is small, that's the best you can do. Now, the other option, which is a big pain in the butt, but for bigger dollar amounts, is what I would recommend. Is you can open a self-directed IRA at places like Kingdom Trust or Pensco or one of these, and then what you do is this is where the pain is, you create what's known as a checkbook LLC, in which so basically your Roth owns this LLC, and the LLC invests in the Bitcoin directly and holds the Bitcoin directly. And in doing so, there's a cost, obviously, to setting up the LLC and the paperwork and so forth. But for bigger dollar amounts, it's worth it. Also, that self-directed IRA can invest in other things as well, not just Bitcoin, things like real estate and promissory notes and all sorts of other things within your IRA. But there is a cost to it that's probably all told about $2,000 right now to get that all set up. So you have to weigh that cost with the amount that you're going to be investing. And again, there are a couple of blog posts on that, as well as resources, people who can set this stuff up for you if that's something you're interested in, and so forth. Or if you want to chat with me about it, I'm happy to do that as well. Okay, so the answer is yes. You just have to decide which way you want to invest, the easy way or the hard way. All right, what else? Any other questions? I know there's kind of a delay, so going once, going twice. All right. All right. Well, if you guys don't have anything else, we will call it a wrap for tonight. Again, I really, really appreciate you being here. This has been super fun for me. And, if you'd asked me a year and a half ago, if I would ever get back in the investing game, I'd have told you it's not going to happen. But, cryptocurrency is special. And it's been really fun to have something that's, this new and exciting and, really, I think like a once in a lifetime opportunity. It's been fun to share it with people that I know and like, and hopefully trust me to guide them in this. If you're one of those people and you want to come along, join the mastermind, you're welcome. I would love to have you. If I can answer any questions for you at all about anything, you know where to find me. My contact information is all over the website. My email is kim@sanecrypto.com, or just give me a call. And again, just a reminder, $100 off if you use the promo code by Thursday at midnight. And that promo code is SANE100. I'll talk to y'all later, and thanks again for being here. Night, y'all.